Thanks for checking out part 4 of the comprehensive guide for stock market beginners. I think maybe I need to rethink that title a bit. Sorry this video took a little while, but this continues on from part 3, where beforehand we understood the basics of stock market analysis, looking at the statistics, and most importantly, trying to understand how to value a stock. So to be able to understand the stocks that we are looking into, whether they are worth investing into or not, whether they are at a fair price. So if you haven't yet, I definitely recommend you check that one out before this one. I'll link it up here and in the description below. But if you have already, then let's continue on. And this week, we're going to jump in a little bit further, and I want to dive in and show you the basics of understanding the financial statements. Every public company has to put these out, and there are 3 main financial statements to know of. This is the income statement, the balance sheet, and the cash flow statement. And understanding these will just help you know whether the company is growing and doing well financially and increasing, and to see if it's stable and able to support itself. So this will help you to understand how safe your investment is and the potential for it to grow, along with understanding any financial risks that it might have. So definitely pay attention on this one. And without further ado, let's jump on the computer and let's get through it. Okay, so we're back on Yahoo Finance again. And I thought we'd start with Facebook again. Just because, obviously we did that in the last video, so it'll be a lot more relatable when we move on. So remember last time, we looked at the summary, understanding the share price and the graph here, and then we moved along to statistics, which just showed us all these valuation ratios to see whether the stock is valued well or not. Obviously we saw that it was just slightly overpriced, remember, with the trailing PE being at 26 and forward PE at 19, but it wasn't too bad. So now, let's look forward and see if we can understand the financials to see it might be overpriced, but maybe it's just a super good stock and that might justify wanting to buy it. So the great thing about Yahoo Finance is pretty much all included on here. So if you go onto financials, this will give you the 3 main financial statements that I was on about before. There's the income statement, the balance sheet, and the cash flow statement here. So we're going to start off with the income statement. And what this basically is, it's basically a breakdown from every single year. So you see here from 2017, 2018, 2019, 2020, and then the year to date, so the past 12 months from now. And this is basically saying how much the company has made for each year, so in terms of revenue and its costs, and what's its take-home pay, so the overall income at the end of the day. So obviously, you want to see a company that is growing steadily and is consistently growing its revenues and profits every single year. So that's the main thing that we want to look to and understand in this one. So I'm just going to jump through and show you the key points of this one and what you quickly want to glance at to try and understand an income statement. Firstly, obviously we have the revenue. This is the top level income that the company gets, so how much in sales they are making. And then below this, you have cost of revenue. So this is the cost of the products which they are selling. And then on top of this is the gross profit. And this is basically what is left over after the cost of what the product they are selling and the profits they are making from that. For example, if you're a t-shirt company selling a t-shirt, the revenue would be the money you get from the customer. And then the cost of revenue would be the cost that the supplier takes from you to make that t-shirt and then for you to sell it to that customer. And the gross profit would be your profit on the end of that. And a good company generally is going to be growing its profits. If a company is stagnant or decreasing, that means it's not moving and it's not really growing. So obviously there's no room for the share price to grow. So what we can see here on Facebook, the revenues are growing fairly steadily each year. Obviously this one is a drop, but this is from the situation of the virus outbreak and stuff like that, and that's obviously going to hit revenues on nearly every company already right now. So you take this one with a bit of a pinch of salt, but you can see over the past 4 years we've seen pretty regular growth, and the cost of revenue has been growing steadily with it. Obviously that's normal because there's more they are selling now, and that reflects well on the gross profits here. We see that gross profits are growing every single year, so that's a pretty good sign for Facebook that it's growing. And then below here, we have research and development. This is basically the research that the company, Facebook, is using to research and explore to try and expand their business, to find out things that other businesses aren't yet. And selling and administrative, it's like the operational costs. So the cost of like employees and stuff like that, and just running the business. And that obviously gives us the total operating expenses, the expenses of running the company. And then at the end of the day here, this is operating income or loss. And this is very similar to the cash flow that they'll have at the end of the day. So after everything's said and done on what they've sold and all the things that are going in between that, what is left over for them? And obviously we can see here again that the profits are growing every year. The only one thing you will notice is for 2019 that there was a slight drop in operating income. And generally I won't be super alarmed about this, it's not a massive drop, but it's important that you do know where this comes from. So if you look onto here, you can see that there was quite a higher sort of selling and general administrative cost here. And there could be a number of reasons for this. Some companies have difficult years for multiple different reasons. But as long as you know where that comes from, and you can see the general trend is growing, then that's a pretty good sign. And here we have all the extra costs afterwards, so the interest expenses on paying back their debts and stuff like that, and all the taxes and stuff like that. And so here we go at the end. This is net income, and this is pretty much what it means when it says earnings. So the take-home pay, what the company gets at the end of everything after taxes and everything. And this is super important to see, because they could be making great revenue, but if there's so much cost behind that and costs are growing and they just can't keep up, then profits are going to be decreasing at the end of the day, and that's going to mean it's a shrinking company. So Facebook here, we can see still on that trend of generally growing up, and it's doing quite well. We can see that drop here again in 2019, but still because of that administrative costs. And then net income is broken down into earnings per share. If you remember from what we were saying about the ratios, the price to earnings ratio is the share price divided by the earnings per share. So this is where this gets from. And this is the earnings divided by all of the shares in issue. So this is what's exactly looked at to look at the PE ratio to see if the company is well valued or not. So it is really super important that earnings per share is growing every year. Unfortunately, we don't have the data on this one here, but you can see that earnings here are much higher. So you'd estimate that this earnings per share is much higher than the previous one below. So you can see that generally that trend of growing is still there. So the company is growing, which is good. And then just a quick note on what's on the bottom here. Do you remember EBITDA? Earnings before interest, tax, depreciation and amortization. This is quite good to look at sometimes instead of earnings. It doesn't take into account taxes and stuff like that. So sometimes this can be a good perspective of whether the company is growing without all these sort of irrelevant things taken away from it. And this helps improve our case a lot better because we can see that it's growing consistently. And that's the income statement. I hope you understood that okay. Basically it's just saying what the company is making and what are its costs, what's its take-home pay. Now let's move on to the balance sheet. And what the balance sheet is effectively looking at the company's health. It's looking at its assets minus its liabilities. So what is the overall value of the company and is it able to support what it already has? So has it got too much debt or has it got enough cash to cover its debt? So the first thing that is super important on this balance sheet is cash and cash equivalents. This is obviously what the company has in terms of liquid assets, what's readily available for the company to keep it going. And increase in cash is a very good sign, and hopefully quite a substantial amount of cash is a very promising sign, because that means the company is readily available to use this cash to either invest in future investments for the company to help it grow, or it can pay off debts or get itself out of situations when it hits the fan. So we can see here for Facebook, the total cash is growing on a general good trend, and you'll see later on that it's quite a significant amount compared to its debts. Net receivables is basically what customers and clients owe them, which they haven't paid yet. And then all of this just adds together for total current assets, which effectively means what the company has ready to spend if needed within 12 months. And we can see that current assets is growing, which is a good sign. Below here, we have the non-current assets, so the things that are long-standing within the company. So we're going to have here obviously property, plant and equipment, which is all the infrastructure and equipment and all that sort of thing of the company. And to see this growing is obviously a really good sign, because that means the infrastructure, the actual size of the company and everything they own that is growing. So it's becoming much more of a substantial business. And then moving on, we'll understand their other investments where they may have other money. And the next one is goodwill, which probably don't pay too much attention to. It's like fairies in the air. It's basically goodwill is the company's idea of this added value which should be placed on top of the company due to its name. So obviously Facebook has such a really good brand name that if a company were to buy them, they wouldn't just be buying all of its assets and everything it has. They'd also be buying the Facebook name, which holds a lot of trust, and people have a lot of ambition and hope for the brand. So that effectively needs to be accounted for. But tangibly, it doesn't actually mean anything because it's just an estimated number of what their name means, really. And then obviously along with this, all the other long-term assets, and all this comes towards bringing in the total non-current assets. And added together with the current assets gives us the total assets. So the total asset value of the company, everything it owns. And we can see here that total assets are growing. So the steady trend is that Facebook is growing as a company in terms of its size and infrastructure and everything it owns. Now, this is super important here. I want you to understand debt, because debt can absolutely crush a business. It can get on top, and if it becomes too big and it ends up meaning they have so many financial obligations, it can really impact their profits. So they might have really promising revenues, but if their debt's so high, it's just going to really crash on this. So they're not going to be able to grow as a company, and it might really cause them big problems later on. So a company with little to no debt is something that you really want to hope for. And we can see here that current debt, it increased a bit over the past few years, and then to date now, they have no current debt, which is good, because this is debt that needs to be paid within 12 months. But if there were to be debt, mainly what you do want to look for is make sure that cash can cover the current debt, because this means that all the liquid assets that I have now, they are ready to just pay that off if they need to. And that basically means that the problem of the current debt isn't too much of a problem. And we can see here that there's actually quite a bit of cash with Facebook. That's $61 billion. And we can see here that there's nothing, or before that's just 277 million. So it covers it easily, so that's a good sign. But make sure that cash covers current debt for sure. And then accounts payable and stuff like that, all the money that they owe and stuff like that, just things that haven't been paid over and stuff like this. And this will add over to bring the current liabilities. Now what you definitely want is for current assets to absolutely cover current liabilities, because this is a good sign that the current company isn't struggling with its short-term situation, basically. And we can see here that it's not really getting too out of control, so that's a good sign. And current assets, you can see, are 75 billion, and current liabilities at 14 billion. Generally, the ratio, which would be a very good sign, would be 2 to 1, so 2 current assets for 1 current liabilities. And at 14 to 75, what's that? That's a ratio of about 5, so 5 to 1. So that's a very good sign that Facebook is controlling its short-term debt. And now probably the most important thing that I probably want you to look into when you're looking on a balance sheet is long-term debt. And this will be in your total non-current liabilities. You can see here that the non-current liabilities are at 16 billion, and it hasn't really gone too far out of control. And with cash being at 61 billion for this current year, and current liabilities 16, it can even pay this off right now if it needs to. So it's definitely in no immediate threat from its debts. But the general rule of thumb, some companies do absolutely need debt because it just helps a company to grow. Make sure that the long-term debt can be covered by 4 years of earnings. That is the total income on the end of the cash flow statement. But obviously Facebook here is covering it very well, so there's no issues there. That will bring us the total stockholders' equity. So how much equity is actually relatable to the owners of the company, which is you, the shareholder. And we can see here that shareholders' equity is growing year on year, which is a very good sign. The company is growing, it's keeping manage of its liabilities, and its assets are increasing. So it's growing as a company. And a growing company is a good company because more than likely that means the share price is going to go up, as long as it's not overvalued. And the last thing I want you to pay attention here is retained earnings. And Warren Buffett is particularly a big fan of this one. It basically means at the end of the day, how much of the earnings is actually retained within the company. So are they able to manage their profits with their overheads to make sure they keep some of that cash behind to allow them to keep growing cash flow as a company. And this definitely needs to be growing, and growing on a consistent level to be a good, solid company. So that's good. Facebook's balance sheet is actually looking really good. There's not a lot of long-term debt, not a lot of debt really, and the cash is growing and it's covering it for sure. So it's absolutely able to stand on its own 2 feet as a company. And the last one here is the cash flow statement. And now the cash flow statement is practically, after everything's said and done with their income, what is done with that money and how is it used to grow their company. And there's not really too much you need to pay attention with this, just kind of understanding how the company is run really. You can see here down, which probably would be a good thing to take note of, is investments in property and acquisitions and purchases of investments. Because if they're doing this, then that is a good sign that they're looking to grow as a company. They're constantly looking for the next thing that they can grow their income and profits. But what's really important is that they're not overdoing this. And the way we can find this is just by looking at the 3 final figures at the bottom here, which are probably the main things you want to focus on with the cash flow statement. So there's operating cash flow, so it's basically all the cash they have available to use in their business after the income's been made, minus the capital expenditure, so all their investments in property and the costs that are going on with all of that. And this will leave us with the free cash flow, which basically means, after all the costs, are they able to leave behind some finances to invest into the future of their business? So are they able to leave behind finances to add to their cash reserves and keep a steady business? And I think a real good example I can think of this would just be for people. Like, these people who, imagine somebody who earns 50 grand a year. They're doing fine, a good job, but they spend all this money on cars and watches and trying to look fancy, and they're almost even taking out debt. And at the end of the day, they're pretty much negative money at the end of the year because they're just spending all the money that they're making, so they're on negative cash flow. And now imagine someone who's earning the same and doing fine, but they're living below their means. They're renting a modest place, and they're just putting behind money every single year and investing it. And now, after 10 years later on, the person who's buying flashy things and spending all the money that they don't have, they're still going to be doing that, living paycheck to paycheck every year, because they're not increasing their cash every year. They're just staying the same. Whereas the person who lived below their means and invested their money to grow, they're in a much better financial situation now. So you can see here that having positive cash flow is just super important for the future of your business, because it means you're looking after yourself, you're looking after your business and allowing it to grow over time. And so those are the 3 main things. And from here, just to give you something to go home with, I think I'll leave you with 5 main red flag areas which you should really look out for if you're trying to understand the company and see whether you should be investing into it or not. So first, let's look into the income statement. And absolutely, the first thing you really need to pay attention to is the net income. Make sure that this is growing, and if there's any anomalies, just make sure you absolutely understand where it comes from. Because if the earnings are growing, then basically that generally means that the share price is going to grow too, as long as the price isn't overvalued in the first hand. Next one, I probably should have said this first, but revenue. Because obviously revenue comes first, it's the sales, it's what's coming into the company in the first hand. And sometimes this can give you a better understanding as to whether an interest from customers to buy from the company is there still. If that's increasing, then that's a very good sign. And if it's decreasing, it's not, because obviously less and less customers are wanting to buy from that company. And that would be a massive red flag for that company. So that's from the income statement. The general trend of that is just make sure it's growing as a company. And then the balance sheet, point 3 area would be look at the total cash. Make sure that cash is growing and make sure that it's absolutely above short-term debt and, if possible, able to cover all of the debt. Having cash is a really good thing because it's just liquid and it's very readily available to help support the company when it hits the fan. If a company has very little cash and it's much lower than all its debts, then that's a very big red flag. The 4th red flag would be long-term debt. This is basically the debt that the company has on its head basically the whole time, and this can cause big problems like I was explaining before. So make sure the long-term debt isn't going up too much and it's keeping good management of it. and that earnings is always going to be able to cover it within 4 years. If it's any more than that, then that's a massive red flag. Long-term debt is way too high, and the company's just going to really struggle when things become difficult. And then the fifth red flag, we just looked at this, it was cash flow. Make sure that free cash flow is positive. It's a good sign that it is investing to its company, but make sure that cash flow is always positive. Like the analogy I was giving about the person who buys the fancy cars, make sure that the company is living within its means, and it's always looking to grow for future terms. That's a good sign for it to be a future profitable business. So all in all, we can see that Facebook is a very well run company. The income's growing and it's looking pretty good. Balance sheet is excellent with lots of cash and not too much debt, and cash flow is positive. So everything's looking pretty good, and so we can understand why there is a slightly higher price for Facebook right now, because it is a well run company and it's growing. So that would mean that investors are quite happy to pay a slightly higher price for it. Obviously, if we look at statistics here, we can see that the trailing PE ratio is at 26, and we said that the fair value in general is around about 15. So investors are happier to pay a higher price because it's a well-run company that is growing and has good future prospects with not too much debt. So obviously that's something to consider when you're looking at a stock. It might look slightly overvalued, but if it's very well run, then you might be able to justify buying it anyway because the long-term prospects are looking so good. And so I hope you found this useful, and let's just finish up the video on camera. I'll see you in a minute now. So that's how to read the 3 financial statements. Don't worry if you found this one confusing, you can always watch it again, and also, you're always welcome to ask me in the comments. I'm always happy to help if you have any questions on anything covered in this section. But if you do grab the basics of this and have a good general understanding of what we just went through, then you'll be well prepared for the next video. And in this next step in the course, part 5, which will hopefully come out soon, we're going to dive into the area of future analysis and seeing how that impacts the price, and ultimately giving us a good idea of where we think the share price might go in the future. So definitely stay tuned for this one, and to make sure you keep track of all the stock market tips that I give out, definitely subscribe to this channel. I'd really appreciate the support. Again, if you have any questions about what we covered today or anything in the stock market in general, please do ask me in the comments below. And with that all said, thank you for watching and speak soon.